What I got, you can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sand. And right now, I'm feeling like 100 grand.
You are listening to Inspired Insider with your host, Dr. Jeremy Weisz.
Dr. Jeremy Weisz here, founder of InspiredInsider.com, where I talk with inspirational entrepreneurs and leaders. Today is no different. We have Skye Fernandes of VUVenturePartners.com and Venture.University. You can check them both out. Before I formally introduce Skye, I always like to point out other episodes people should check out of the podcast. And since you have some amazing portfolio companies that you've invested in and serve, and so I'm trying to think of some of the cool ones that we've had on the podcast. Active Campaign was a really interesting one. If anyone's heard of Active Campaign, the email marketing and email, you can send out great emails to your list. Pipedrive. I remember when I interviewed Pipedrive, they had, I think, 10,000 customers. Now they, I think, have over 100,000 customers. And so you just see the growth and trajectory of some of these companies, and that and so many more you can check out on InspiredInsider.com. And this episode is brought to you by Rise25. At Rise25, we help businesses give to and connect their Dream 100 relationships. And how do we do that? We help you run your podcast. For me, Skye, the number one thing in my life is relationships. I'm always looking at ways to give to my best relationships. And I found no better way to do that than to profile the people and the companies I most admire on this planet, have them on my podcast, and they can share with the world what they're working on. So if you've thought about podcasting, you should. If you have questions, go to rise25.com or email us support@rise25.com. And today I have Skye Fernandes, and I was mentioning, I can probably go on, Skye, for 15, 20 minutes on the accolades, but I'm going to hit a few of the highlights here. Ranked top 100 powerless VC, 10 plus years of VC private equity investing, 100 plus portfolio companies. Some of them include like Beyond Meat, Sensity, Shopkick, Made in Space, FabBit Fun, Bear Flags Robotics, which was acquired by John Deere for $250 million. Former managing director of investments at Cleveland Avenue, which was co-founded by the former CEO and president of McDonald's, and they focus on food and beverage brands. And the list goes on and on and on. So, and even a board game, co-founder of a board game, the next big thing, the game of entrepreneurship. I'm gonna have to get that. Where can people get that?
You can get it on by going to the next big thing, boardgame.com, as well as Amazon. Yep.
Awesome. We got to play that at home with the kids. I love it. Skye, thanks for joining me.
Awesome. Yeah. Thanks for having me, Jeremy.
So tell me about VU Venture Partners and what you do.
Oh yeah. No, thank you. So we launched VU Venture Partners about 4 years ago with the goal really of how to disrupt the overall venture capital asset class and allow ourselves to really be a helpful center of the ecosystem for the entire industry. The fund itself is a kind of seed Series A focused fund where we make investments of about $200,000 to $1 million. We're pretty actively investing, so we do about 20 investments a year. We now have a little over 70 portfolio companies. We are a generalist fund, so we invest in everything from consumer to the more frontier-oriented things. Internally, we have 6 deal sourcing teams. So each of them have their own vertical expertise. We have our consumer team and our enterprise team, which are super generalist teams. And then we have our fintech team, our frontier team, our healthcare team, and our real estate prop tech team. So we really pretty much cover everything. Unique about kind of our fund really is the scale that we've built. So we probably have the largest investment fund by number of investors and the number of deals that we source and evaluate. So we operate in 3 kind of core locations with headquarters. We have San Francisco, New York, and Hong Kong. We have 70 investors on our team, and we source and evaluate about 20,000 companies a year. So about a 10 times larger seed Series A fund by number of investors, and about the average VC sources about 2,000 to 3,000 a year. So we're at about 20,000. So our goal is to really be building out the top quality venture portfolio, in that we're hyper picky. We only invest in about 0.1% versus the average fund invests in about 1% of deals. And we're really leveraging the experience that myself and my 2 partners have, about 45 years of venture experience, where we've been some of the earliest and largest investors now in about 17 unicorns, where we're coming in at the very early stages for those companies.
Yeah, when I was on your site the other day, Venture.Partners.com, I was looking at your team page and it kept scrolling. Like you have all these different teams. And then same thing with the portfolio. Usually the sites I go to, they'll have like a section. But when I go to the site, there's consumer and you have like law champs and fan controlled football league. And then you have, enterprise. And then you have, the fintech and blockchain. So you cover a lot of categories here. Talk about starting the company. How'd you know your partner and what made you decide to start the company?
Yeah, great question. So really, I've been doing venture capital now for close to 15 years. And the goal was if I wanted to go and launch my own fund, really wanted to do something that was differentiated for the ecosystem, but also really benefiting the ecosystem. So the idea of the VU itself comes from Venture.University. So we created an investor accelerator tied with a venture fund to give us this scalability. So people do Venture.University for 3 to 12 months. And so the idea, again, about 5 years ago, was could we do something that would disrupt education plus disrupt the venture industry? And so I pitched the concept to my now partner, Andrew, Andrew's been doing venture for about 25 years. He was one of the original partners at RRE Ventures, one of the top performing venture funds on the East Coast. And people have been wanting Andrew to launch another fund for a while. And so I met up with him in San Francisco on Market Street at a cafe and pitched him the concept. And I said, if we execute this, we will become a really helpful industry player, and it will be helping to create the top talent for the industry. But we'll also be creating a way to create consistent and outperformance on financial returns for our investors with this really kind of innovative approach of merging an investor accelerator concept with a venture fund. And he loved it. And his wife actually tells the story best. When he went home, he had a little smirk on his face, and she goes, why are you smiling like that? He goes, I think I found the thing I want to do for the rest of my life. And so really it was amazing to get Andrew onto the team. Andrew's obviously background is notable, has a 100% plus net IRR for the last 25 years, early investor in companies like Facebook, Uber, Twitter, Venmo. And then about 2 years later, looking to expand internationally, we then launched our Hong Kong office and ended up meeting up with James. James, amazing background as well, previously at Coachella Ventures and then at SoftBank's China Fund, and then was a co-founder of Formation 8, now 8 VC, notably kind of created by Joe Lonsdale, who's early kind of incubator of Palantir and Weisz, and a guy named Gideon, who's the former CFO of YouTube and Facebook. And so James, awesome background experience, early investors in companies like Oculus, Weisz, Palantir, Oscar. And so it's amazing having really strong partners for each of our core geographies, for Hong Kong being James, me and Andrew doing the US. It's just really amazing to have partners, each of us kind of having our own solid experiences where we've been investors, where every fund we've ever done, we've at least been able to get one or more companies that have returned the entire fund, and just being able to also learn from those case studies. We bring a lot of those case studies into the Venture.University curriculum that we've created as well. And probably the thing that is, looking back just on the last 4 years now, probably the thing I'm the most happy about is that we've achieved really a VU family. The fact that the VU family now extends to 500 plus alumni and a really tight-knit community of people working in other funds, launching other funds. And that VU family has probably been the most special thing, where we've really created something bigger than ourselves and something that's helping others pursue their future careers, as well as helping the overall industry finding great talent.
Sky, I want to just say this: genius, and any company listening to this should think about, how do you create an education and training program that has built in it helps the ecosystem, but it also is a built-in staffing that you're training up to contact you, right? And that's really smart. It's very meta that you were pitching a VC about starting a VC fund. I'm wondering, you've heard thousands, maybe tens of thousands of pitches via email or in person, and then you were giving one. What did you incorporate into that when you were telling about it? And then I'm also wondering, what do you look for in when someone's pitching you?
Yeah, I think what I guess looking back on the last 15 years of doing VC, I would have to say that it's largely weighted towards market size opportunity and how extraordinary the opportunity is in terms of magnitude of improvement. And I think, now I've done close to about 160, 170 investments. The bar for me of what I get excited about consistently goes up. And we do a lot of fireside chats at VU. And a consistent question I ask is like, what would you also tell like your younger self as a VC? Consistently, the answer is I'd have a higher bar of what extraordinary is when I make investments. And I think that's very true. So I certainly don't have an itch to scratch to like make another investment. I do have a passion for just going after the largest possible disruptive market opportunities. So something that we actually spend a lot of time teaching at VU, building out an investment thesis is how do you actually go after something where the market size is truly large, and understanding that spectrum, like high level numbers, the difference between a company worth 100 million and $1 trillion, which we now have a handful of companies worth over $1 trillion, is about a 10,000 times difference, being worth 100 million versus $1 trillion. And that is a huge spectrum of potential exit valuations, and that's largely driven by the actual market size of the opportunity that you can go after. So having a higher bar for what actually is a big market size is a big one that we focus on. Team also matters, and I think team is certainly the MBA answer that many people often have. I think team is probably a really good answer if you're in private equity, where the company is already doing great and basically it's like don't screw up. When it's a situation of like don't screw up, I think team matters a lot. But when you're actually on the venture side and startup side, I think you need a solid team. But I think the people that execute really, really well, while they execute well, I don't think the difference in humans' execution capabilities is 10,000 times different. And so I think the weight for me actually goes a lot more towards market size opportunity than team. You want to have an A team and an A market, but there's enough, I think, data now that I've been supported by that shows that you could even have a B team going after an A market and end up with a much, much bigger exit than if you had an A team going after a B market, where you can't grow into a big enough market to get a venture return.
Sky, I think of it kind of in the baseball realm. Like if you are batting 300, you get 3 hits out of 10, you're a Hall of Famer. Right? And same thing in your world, that you can't be right 100% of the time. Where's something that you underestimated the market size, where you said, oh, they came in and, you've hit a lot of home runs, but there's also singles, there's also outs there. What was something that looking back, you're like, yeah, the market size was bigger than I had suspected?
So smaller than you expected.
Smaller, right? Smaller.
Yeah, I would say.
Either or. Someone came in, you're like, that's not a good one, and they actually ended up being bigger.
Actually being bigger than I thought. Interesting. I'm not sure I have any good examples of where the market was a lot bigger than I expected it to be. I think what I've learned earlier in my career was where I overestimated the ability of having really high market penetration in smaller markets and thinking that I could win that way. It was almost trying to fight against my general rule of just going after a really big market. But sometimes if you do go after smaller markets, you hope that you can get a greater than a 1% market penetration, and that obviously can not be true. A good example I have there is I invested in a company that rents bridesmaid dresses. The idea that with men can rent tuxedos. Why can't you rent bridesmaid dresses? Because they're not usually the best looking. They're expensive, and you wear them once. You should totally be able to rent bridesmaid dresses. And when you do the market size calculation, there's about 2.2 million weddings a year, relatively stable number of weddings. There's not like a significant increase or decrease in the number of weddings traditionally, except maybe COVID. I'm actually curious to see how much the number of weddings decreased maybe during COVID, but they maybe continue to happen virtually. But roughly 2.2 million weddings a year, average is about 5 to 6 bridesmaids per wedding, which gives you a market size of about 11 or so million bridesmaids to sell to. And the thinking there was, if you renting a dress for $100 to $200, you can get to a market size of about 100 million or so, which is not big enough to really get to. Really, our target is usually a minimum of a $10 billion market size, and so we definitely had hopes that maybe they could get like a 10% or 20% market penetration. And because the market wasn't actually significantly big, being able to just generate initially large amount of revenues was tough. And I guess that's really, the big driver of why market size is so important is the bigger the market, the easier it is to start getting to, bigger revenues sooner, rather than just hoping for big market penetration. But yeah, looking back on that one, I really liked the concept. And I think I might have been more passionate about the concept than I should have been on rationalizing the opportunity size.
Do some of those, and of course, like that, when you say that, everyone's like, oh, yeah, that's of course, that makes perfect sense. Do any of those type of companies that maybe, do they go into other markets to expand, like, in that, like prom dress? I mean, I'm just thinking of things like what else do people even wear once, right?
Company, they were planning to expand more into the wedding category of doing wedding gifts and other props that you can have at weddings to have incremental revenue. But I guess that's another flaw I would say in venture is you should be investing in what the company can execute today. If you have too much faith that you're betting on what the company will eventually develop into, I'd rather invest in a company that's actually gotten the business model now that can be successful and could be a cherry on top and not require the future business model to actually happen to make it a success.
Yeah, totally. Talk about Bear Flag Robotics and from the beginning, what was the pitch or what you saw and then what happened?
Yeah, so a little, the level setter's background on what Bear Flag Robotics is. So it's an autonomous driving tractor that doesn't have a human driving the tractor. So basically allows it to drive significantly longer at all hours. That can overall increase the number of turnover of crops. And so we had looked into the robotics space for autonomous driving for a while. I was actually early friends with Kyle, the founder of Cruise Automation, and it would actually end up being a very similar story to Cruise in many respects. On outcome. But we looked at the fact that the future is becoming autonomous, and we look for the things that will probably get replaced by autonomy are going to be the lowest skills of labor first, and it'll kind of move upstream to more and more higher skills. And driving is certainly one of the lowest skill sets that one can have. I'd call probably the next hardest one would be like cleaning. Because you have to be a little more detailed and finessed in what you're actually cleaning. But if you have like a robot cleaning like hotel bathrooms, it's probably orders of magnitude more complicated than just driving around the streets. Tractors are great because they go slow. Where nobody is walking, there's no other vehicles, so it's actually an easier commercialization problem to solve for than even cruise automation, self-driving cars. So we liked the opportunity. We were not expecting for as early of an exit as that it happened. We ended up investing in about 14 months later. Bear Flags was acquired by John Deere, the big tractor company, for about $250 million. We came in at about a $27 million valuation, so we made just shy of a 10x. It was right around a 9x for us. Obviously, phenomenal opportunity, but from a case study perspective, I guess it's a really insightful one because it shows also why, again, market can matter even more than traction. At that time, Bear Flag Robotics had no revenue. They were pre-revenue. They were basically just in pilot mode of doing a few pilots. And they were going out to raise their Series A, which was going to be a 25 million Series A at roughly a 125 post. And John Deere basically said, hey, how about we just acquire you for 2 times your upcoming Series A valuation, and we just call it a deal. And from an opportunity cost, that's usually the clearing price. And it's actually a very good data point for founders to remember, is that oftentimes if you are looking to sell yourself and you're going after a big market, oftentimes 2x your upcoming like post-money valuation is frequently a clearing price that previous investors would be happy with. In our case, we're getting a 9x within 14 months. So nobody said no to that acquisition. And the founders had to contemplate, is it worth going after a $500 billion exit, or are we really happy with 250? And was actually great about that deal with Venture.University. Our cohort 8 invested in Venture.University. Cohort 8 invested in Bear Flag Robotics. And we have a profit sharing agreement for those that participate in VU where they get an upside in the deals that we do. And Bear Flags ended up returning about a third of the program cost of doing Venture.University, which is awesome. And they still have all the other deals in their portfolio to get upside from. But that story pretty much panned out very similar to how Cruise Automation panned out. Cruise had been around for about 18, 24 months, was going out to raise 100 million Series A at about a 450, 500 post. GM came in and said, how about we buy you for $1 billion, 2 times the upcoming Series A valuation. And ultimately, that's the reason why Cruise and Bear Flags got acquired for what they did. It had nothing to do with revenue traction. I'm sure the teams are certainly amazing. Kyle at Cruise is amazing. The founder of Bear Flags is amazing. But if it wasn't actually going after such a super large market opportunity, those exits would have been a lot smaller. They would have been more like acqui-hires for $10 million or something at best. And so again, really focusing on going after truly disruptive market opportunities that get you a magnitude of improvement that's more than just an iteration, but truly actually leapfrogging ahead when it comes to cost savings and optionality.
There's 2 questions I have, Sky, and obviously that's pretty remarkable that people who are involved in Venture.University can participate in that. So I want you to talk about that and who's a fit for that and how do they join that. But how does a company like Bear Flag Robotics, how do they come up with that $25 million valuation? And even if they come up with a valuation, you have to, the investors have to say, oh yeah, that's good, right? And this is especially before this is pre-revenue. So how did they come up, or what do you look at to assess, yeah, that's fair, because they have no revenue?
Yeah, and we certainly teach this in greater detail at VU as well. Really, when you're talking about how financing valuations are done, in general, it's initially anchored based on the investor's target ownership of what do they feel is an ownership that they need to get their required return for doing the investment. That's ultimately what it comes down to. It does not have to do necessarily with any current traction nor market size in the beginning. It really is just from what I think I could make on this investment overall, I back into what I think the valuation should be. And so typically we're looking for a 10x return as a minimum. And I stress that as it truly is a minimum. Most of our investments are between about a 10x to 100x return. And so from basic math, if you're going to say, hey, I want to raise $2 million for my seed round, well, if I come in at a $10 million post with for 20% ownership, then in order for me to get a 10x initially, you might think that it's a $100 million exit to go from 10 million to 100 million. But that's only true if you never have to raise capital again. Assuming that there's going to be multiple rounds of financing as you need more and more capital to grow bigger, we assume that there's probably going to be at least 2 to 3 more rounds of financing before an exit, depending on the stage. If we're coming at the seed stage, we assume that there's going to be 3 more rounds of financing at least. If we're coming at the Series A round, we assume there's at least going to be 2 more rounds of financing before an exit. And so assuming that each round, on average, historically, for kind of pre-seed, seed, and Series A, they average at around 20% ownership for companies that are raising 18-month runways. If you're raising like 24-month runways, oftentimes ownership can be like 25% or 30%. But the average then, like Series C, ownership historically has been around 15%. Series Ds can end up at 10%. And so we factor all that in to say, okay, if we're coming in for a $2 million seed, if we come in at a $10 million post and get 20%, the company doesn't need to exit at 100 million. They really need to exit at 200 million because after 3 rounds of dilution, after your initial round, your ownership is divided in half, which is another good bullet point to or golden point to remember. 3 rounds of dilution basically halves your ownership. So if we're starting off at 10% ownership, 3 rounds of dilution at 20%, we'll have 5%. And we need, then double the exit size to get a 10x. So from that logic, you can see that, 10 actually needs a $200 million exit. With Bear Flags, same example. When we initially invested, we came in at a $27 million valuation, knowing that if the company never raised any other round of capital, we'd get a 10x at around a $250 million valuation. But the market size was big enough to be able to support potentially an exit significantly greater than that if they raise more money and continue to grow. And so, fast forward, a $250 million exit is ultimately what happened in 14 months. But had they gone out to raise a $25 million round, which actually they were already out in the market raising $25 million, at 125 posts, again, a 20% ownership even for the Series A. At that point, the company would then have to exit north of about 500 million for probably those initial investors to be hitting the initial target of what they're looking for.
Yeah. You really have to be a numbers person with this, because when you're looking at the market size and then kind of backing into those numbers, you're not even saying, oh, John Deere might acquire them someday. You're looking at the full market size. And then, if the market size is there, then those companies acquire them will be there too. Right.
Actually, good point on that. Yeah. So you're looking at certainly what is the total market size of like tractors that could be used by Bear Flags. We are looking at who the potential acquirers could be, and we're looking at their market valuation. So I think John Deere is worth about 40 billion or so. So if you're worth 40 billion, could you buy a company for $1 billion for 1/40th? 100%. Could you buy it for 2 or 3 billion? 100%. I'd say it's such a huge, importance to John Deere's future. You could probably pay 5 billion, 10 billion. You just look what happened with Cruise Automation, with GM buying it. Cruise is now worth about, a third of GM's valuation. So extremely important to future companies like that. And so you benchmark what you think is realistic. If the biggest company in the industry was only worth 10 billion, my outcome of what is possible might differ. Really, kind of then saying this might require an IPO, and there might not be a lot of great potential acquirers. And so you really have to go for something that has IPO potential, that can be ultimately the company that acquires other companies and gets so big that no other company can acquire it.
Yeah. I think of poker when you're talking about this, which is like, if you have, 7, 8, 9, you have 2 outs, or 7, 8, 9, you have 2 outs. Maybe you have like all clubs in 7, 8, 9. So you could get a flush and you could also get a straight. So you're looking at both things here as like how the highest percentage of odds of success here. And there's a couple different pathways to that. And I have 2 last questions, Scott, and I don't know if you have to jump off right at the hour, because I want to be respectful of your time.
Good, yep.
But I do want to go into Venture.University and how that works, because people can get into Venture.University if you allow them, and they can participate in these things. That's pretty remarkable. So talk about Venture.University and who's a fit to go there, and how does it work?
So it's really designed for people that are interested in learning more about venture capital and private equity, and even more so people that want to pursue that as a career. If you were to go to a top business school like Harvard Business School or Stanford or Wharton, your probability of breaking into VC and PE is probably better than if you went to a lower ranked MBA program. But even if you went to a top MBA program, you're not guaranteed work experience. You're still praying during the summer that you get a job. And so I think what we've now proven out with our model is we have a really high success rate. For people that have graduated within 12 months, about a 64% of our alumni have now gone into venture capital and private equity. So a much higher success than even going to a top MBA program. If you think about the target demographic, it's relatively broad. You have people that are looking to break into VC and PE from the analyst, associate, principal, and partner level. You have people that are looking to launch their own fund, so emerging fund managers. You have family offices and angel investors that are looking at professionalizing their direct investment strategies or becoming LPs in funds. And so it really is on kind of stage of life is pretty broad. Every cohort, which is roughly about 50 people in the US and Europe, we have a goal of really hitting around 25% for every 10 years of age. So people that are in their 20s, 30s, 40s, and 50s. So it's not a program just for people that are coming out of college or MBA. That's actually the minority of people. There really is a full spectrum of, covering about 4 decades of life. And people bring a lot of, people that have been working for 20 years, they bring a big network and a big amount of expertise in being able to source deals, do due diligence. And that's what you're looking for, obviously, when you're trying to make great investments. The other thing I would say is that we have a big focus on diversity. So one of our recent cohorts, we had about 40% of the cohort were women, and about a third were underrepresented minorities. So we're also significantly moving the needle when it comes to what the face looks like of the venture capital private equity industry. And we're creating a pool of talent that is successfully being hired by the industry as well. And that's creating this network effect of the kind of the VU family where people are now working at other funds. As an example, just last week, one of our alumni is now working at Sony's Innovation Fund, and another person is a partner at a fund backed by a large Asian corporate. So Sony being an Asian background and this big Asian corporate, I was able to connect two people across two different cohorts that are now working in the industry, and there was a big value in doing that. So there's a huge long tail value that people have from being part of VU. We also just started kicking off alumni events, where every quarter we do an alumni event, bringing together, we now have a little over 500 alumni. And so that quarterly event, getting to touch base with your cohort members, previous cohort members, incoming cohort members, builds this really wonderful long tail of helping to find future job opportunities, future investments to make sure that you can stay top of your game and performing really strong within your career overall.
And people can go to Venture.University, check it out, and you have to apply, and there's different dates of cohorts. What's the most common questions you get with it? Is it, do people ask about time commitment?
I think, often people are curious about, is this like an internship? And I'd kind of share that it's completely unlike an internship in so many ways. The real goal of Venture.University was to build a very structured academic curriculum. So you have a master class and advanced modules. You wouldn't typically have kind of a really robust academic curriculum with an internship. And two, from the work experience that you're getting is a much more senior, elevated, and intense experience. With an internship, you might be doing a lot of kind of BS work of filling out PowerPoints and Excel sheets. Your probability as an intern to bring a deal to a partners meeting is pretty low. Your probability of bringing a deal to like the investment committee, also extremely low. At VU, you take a much more senior role. So you get to decide what deals are brought to the partner meetings, what deals are ultimately brought to the investment committee, and then voting on the investment committee, and you get a piece of the upside. And so it's, again, a much more intense experience where you get a much higher quality investment experience out of it. And outcome, I would also say, is a lot higher as well, given the stats that we've had over the last 4 years. So the apprenticeship is definitely one where we spend a lot of time working with everyone on developing them. So you have a people that are really dedicated the rest of your life to making sure that you're successful in your career. I guess another common question we get is whether they can do it part-time or full-time. Given the future of how COVID has affected things, people can join it virtually. People can do it in person in our San Francisco office or in person in our Hong Kong office. And we have a growing number of people that are now coming back doing it in person. And you can also do it part-time and full-time. The program is designed where it can take over your entire life and you get a ton out of it. You can also do it part-time and get a lot out of it as well. But the more you can put in, the greater value anything will usually be. But we did design it for flexibility for both part-time and full-time individuals.
Nice. Thank you. Yeah, that's at Venture.University. Sky, Contraline. Talk about that.
Fun one. We have it. Contraline is coming up for another follow-on round for us. We've already been an investor in the company for the last, I think now 3 years. Contraline is a male birth control, which is a fun and controversial, topic, but one that is very much supported by, if we really do want equality, it's hard to argue against male birth control. And it's one where there's a lot of different approaches that companies have looked at doing. We're a big fan of the Contraline approach. It's a non-hormonal option. So where women have the pill, obviously doing a pill for men, there's a hormonal aspect, which would take way longer to go through FDA approval. Who knows the effects that would happen 5-10 years down the road with any kind of effects to your hormones. So we, in general, when we were looking at the market, we didn't want to go after anything that was a hormonal solution. The other options that men currently have are abstinence, which isn't all that much fun. You have condoms and you have vasectomies. And vasectomies are, snipping doesn't have a great, visualization either. But it seems a permanent.
Lasing your vas deferens does not sound pleasurable. Oh,
exactly. Yeah. So the idea that you could have a reversible vasectomy is quite novel. And if you take a step back and just look at the market size for Contraline, right now vasectomies is about a $500,000 market, which is actually not very big, 500,000 men. And it's very narrowly on men, usually in their late 30s, early 40s, after having 2 kids. They think maybe I should get a vasectomy. But the idea of a reversible vasectomy, you open up the market significantly to people that are in their late teens, 70, 80 years old. The market size just is hugely expanded with a reversible option. And the way that it works is it's an injection of a hydrogel. It takes about 15, 20 minutes, and it hardens, and it basically blocks sperm coming out of the vas deferens. The nice thing about it, too, from an approval perspective, vasectomies have been long approved for a long time. This is just a reversible version of that. So we think that the FDA approval will go relatively smoothly and fast, and hopefully be able to get to market relatively soon. I have 2 young boys that are 2 and 3 and 5 and 6 years old, and they are. I'm hoping in the future, by the time they go to college, this becomes an option for them. It would be nice to have that. But again, all goes back to then providing additional responsibility for men, not just women, to be responsible for the reproductive future of humans, and really, really excited about that opportunity. So we have that one coming up. It's one of my more favorite portfolio companies, given I think there's a social big benefit that comes out of it, but also just a massive market opportunity as well.
Yeah, that's fascinating, Sky. And I don't want to get too deep into the science if you don't know this. I'm just curious when you say that. I picture, it hardens around it, blocks it. Is there like an antidote where they inject an antidote and like the gel dissolves or something?
Right. Yeah. So great question. So it's similar to an IUD for women. So women have the other option than a pill is they can have an IUD that lasts a year, 2 years, 3 years, 4 years. This is designed, the hydrogel that's able to dissolve over time. And it kind of has a rapid dissolving mechanism after a certain period of time. So same thing. If guys don't want to have the worry of having a kid for a while, you can do it for 1, 2, 3, 4 years, but it can be reversed as well.
So it maybe automatically reverses, and then you'll have to get another injection at some point in the future. So
exactly. Yep.
I got you.
But it's very much kind of the equivalent for almost an IUD for men. Yep.
Got it. So Sky, last question here. And thank you. First of all, I want to point everyone to VUVenturePartners.com. Check out more, Venture.University, learn more. We've talked about founder fits and some of the things you look for, who's a fit. We talked about, Venture.University, some of the training you're doing. We haven't talked about, there's so many moving pieces with your business. And one of the things you do is you are also raising funds alongside this as you get more opportunities. So talk about that. Who's a fit and what do you look for as far as the raising fund side?
Yeah, thank you for asking that. Yeah, so we have both our investor syndicate and we have our committed fund. Our investor syndicate is for angel investors, that want to invest $5,000 as a minimum into companies, and so people can go to VUVenturePartners.com and sign up. There's no cost to joining; it's completely free, and you'll start receiving the deals that we're investing in on a quarterly basis. You'll receive probably about 5 to 7 or so deals a quarter, knowing that we've vetted them out of thousands of opportunities, about 20,000 a year that we look at. And they're deals that we're putting our own capital into as well. So we only share deals that we're investing our own capital. Really high quality deals, co-investing with a lot of other top tier funds, always shooting for that kind of 10x to 100x return. So for angel investors, that are accredited investors, family offices, definitely a good fit for them if they're looking to find a platform where they can invest on a deal by deal basis. And then we also just kicked off raising Fund 2, which we just did our first close on a few weeks ago, and we're continuing to go out to raise the remaining of it. That'll be a $100 million fund. That's really targeted for investors that are looking to deploy a larger amount of capital, minimum checks of about $500,000. And so it really depends on deal by deal, or if you're looking for a committed fund approach, we certainly have both of those. And we also train everyone that goes through VU, kind of the way to grow their own syndicate as the way is to grow their own committed fund. So we use those as 2 great case studies in the approach for how we're going about that. Really impressed. Our results so far have been fantastic. We were actually just doing an IRR update for ourselves, about a 72% IRR so far for our funds, which puts us in roughly top decile when you look at the overall asset class, especially for our kind of 2018 vintage of when we started. Really, really proud of proving out that the model itself is working. We've proven that we can have a model that scales, is able to really achieve something that no fund has ever done before, and be able to evaluate a much larger part of the market to narrow down to truly the best investments happening in the venture asset class.
Yep. Sky, I want to be the first one to thank you. I could talk to you all day and hear company by company portfolio because it's really fascinating. Everyone can check out VUVenturePartners.com, Venture.University, and more episodes of InspiredInsider.com. And Sky, thank you so much.
Awesome. Thank you, Jeremy.
Thanks, everyone.
What I got, you can't buy. It resides between my eyes. Walked through the fire, came out better on the other side. See, life's like a beach if you find the sailing right now. I'm feeling like 100 grand.